and now the first rate on the Sensex and the Nifty, they've started kicking in. It is not a scary start, 0.5% is not scary, but in the context of where it was in terms of the market positioning, it's a downtick. I think is clearly visible in the way how the market breadth and how the Nifty also seems to be moving. So for me, I think it's important to establish that the market breadth for the first time after many days is looking meaningfully weak. It is looking meaningfully weak in terms of the total composition. So it's a lot of red on the screen, and I think markets will have to deal with the weak open today, and then you're going to take it from there. Where is the bank Nifty? Down. Small cap index down. Mid cap index down. And there is definitely a global headwind which is having impact on the market per se.
Yeah, absolutely. Couple of other names which are going to be in focus. Paytm, let's see where the stock price has settled in at after that ANFIN block deal which just happened. Stake worth about 2,000 crore rupees at a floor price of 880, 922 on that stock, and that's a big move, about 2% is what you're seeing. There's Amber Enterprises as well, wherein the PE firm Ascent is likely to sell that 4% stake worth about 380 odd crore rupees, 3.5% higher for Amber as well. Birla Soft, wherein Nomura has initiated a buy with the target price of 610. The Sirma SGS as well, long-term aspirations of $1 billion revenue is what the management has indicated in their management meet, and appointed a new CEO as well over there. Also, there's Bharat Electronics as well as other defense stocks as well. Remember, the Defense Ministry has approved proposals worth about 7,800 crore rupees. I mean, as much as you may think that there is exuberance in this sector, but the news flow as well continues to chug along the positive line. There's Shoppers Stop as well, wherein the CEO, Venugopal Nair, has resigned with effect from August 31st. Of course, they have a new CEO in place. Let's see how that stock has been reacting. Gap down 6% lower for Shoppers Stop as we speak right now. Couple of other reports as well. Aurobindo Pharma and the Times of India has reported this morning that promoters have restarted injectables business stake sale process. That stock holding higher by about almost 0.5% or so. There's Manappuram as well, wherein Cunard has sold about 8.3 crore shares. Domestic mutual funds have been buyers. So that's one another stock in focus. There's Max Financial as well, wherein the promoter Max Ventures sold over 1 crore shares. Mutual funds have been buyers. RBL Bank, CDC Group has sold about almost 99.5 lakh shares via block deals. So a lot of block deal related stocks which are in focus as well. And then of course, there's Indiabulls Housing as well, which we understand they've repaid that over 2,200 crore rupees to ANZ Banking Group and Barclays Bank PLC as well as SBI. That stock holding up almost 2% as we speak right now. You've got the telecom subscriber data as well for Reliance, for Bharti. It's been net additions, and of course continues to be a loss for Vodafone Idea. Although Reliance continues to be under pressure, down another 1% in trade right now. And since we're talking about Reliance, let's see what Jio Financial Services is up to and whether it continues to be locked in lower circuit or not. That stock will just come up for you on your screens. Yes, once again, 5% downtick, 202 on that stock right now. But significant pressure on the index as well, Kunal. What are the first trades you're punching in?
Yeah, so for the, I think from the index point of view, there is definite amount of weakness. We've managed to, ebb back on the premium for the indices. So again, that's a critical sign for the index, especially going into the expiry week next week. In terms of opening trade, Nifty is something which I would look to sell in the open. That's something which we discussed earlier. That's a strategy which I'll take at the opening hour of the index.
All right, Naresh, let's get in a sense as to what you're making of the market open this morning and what's the first trade that you'll be punching in.
So on the Nifty, we are seeing a gap down. We are seeing a flat open on the small cap index as well. So the trend continues wherein index remains under pressure, broader markets not in a similar pressure. The stock I would be looking out to buy would be IndusInd Bank closer to 1400 levels or at about 1435. That's the stock which is showing leadership out here that could break out over the short term. So it would be IndusInd Bank on dips or on a breakout.
Financials are not doing anything special, even though it seems to be the consensus view. And I think that is how consensus sometimes moves, that it just tends to price in the near-term growth really ahead of its curve. I think that's visible in the case of our financials, despite being a consensus view, high growth sector, have done pressures little. But Nifty is under pressure, Bank Nifty is under pressure, lots of block deals, lots and lots of block deals. I think that's now been the real center of how the flows and the institutional activity has been. Saurabh Mukherjee joins us. Let's connect with him to understand that his view on the market, where is he picking his spots, and why are financials underperforming. Saurabh, fantastic to have you back as always. Thank you for joining us. Saurabh, there seems to be a bit of a change in the macro narrative, whether it is local or global. Locally, you can blame it on tomato prices and onion prices. Globally, we could blame it on what's happening to the dollar index and how China is moving.
I think the macro narrative, I think, is probably the best we've ever had it. I think I can't remember a juncture in Indian history where the economy is running at 6.5%. We're close to the top of the interest rate cycle, and the Chinese economy is blowing up in front of us, right? China blowing up, the implosion in China, the fact that they're struggling with GDP growth, with exports, with employment. I think that has massive implications. It's almost inevitable that the Chinese economic slowdown will exert massive deflationary forces across the world on commodity prices, on oil prices. I'm not so sure central banks or the bond markets are reflecting that just yet. China's economic boom over the last 20 years supported commodity prices. I think China's economic unwinding, perhaps its economic collapse over the next 10 years, will have a deflationary impact. As and when that becomes apparent to bond markets and to central banks, I think the narrative that we are close to the top of the interest rate cycle will solidify, and therefore the jitteriness that we see around interest rates, I think, will abate over the next 12 months.
Saurabh, everybody's excited about the way our financials are moving. It's a consensus view, and it's a space where the growth, I think, is evident. But somehow, if I look at the performance of financials, and especially for large cap banks, they've been quite numb this year. The contours of growth are favorable. The valuation stack is exciting and not stretched. Yet the price performance in this year for the large cap banks has disappointed.
I think part of the reason for that is the funding conditions are reasonably easy for the lending ecosystem. So whether I look at NBFCs or the banks, raising money primarily CASA money or indeed wholesale market money has been reasonably easy. And whenever you have that, Nikunj, whenever getting access to funds is reasonably easy, it's very difficult to separate the men from the boys, the women from the girls. What we will need is some sort of shock in the system around either loan losses, around some development of bad news around credit quality, for the market to differentiate between, say, HDFC banks and Kotak banks on the one hand, and say the PSUs on the other. At the moment, the market is saying, why should I buy private sector banks if the PSUs can deliver stellar profit compounding quarter after quarter?
Hi, morning. I'm quite intrigued to see that you're actually calling specialty chemicals as a preferred sector at a time when just about every player has come out there and given a guidance cut, talked about a gloomy scenario. Is this a buying the fear strategy?
No, so specialty chemicals, I think people aren't drawing the distinction. Agrochemicals, China is dumping globally. Agrochemicals are therefore under pressure. So, for example, we don't have SRF, but I think it's a high-class company. The SRF management has been clear that China is dumping, and that's exerting pressure on SRF's profits. But in pharmaceuticals, medicines for human beings, there is a shortage. America is going through a massive shortage in, for example, oncology drugs, in contrast media. Contrast media is the stuff we have to consume before an MRI scan. And therefore, what we are seeing is the API space. The API space supplies into the pharmaceutical space, and the intermediates which go into APIs. There is no global glut there. We are not seeing price pressure on API. And as I've said several times on your show, Aisha, China makes 70-80% of the world's API. If India can grab even 10% of that, our API industry doubles. So we quadrupled our position in Divi's lab in November, December last year, and we're continuing to try to make more investments in this space, the space which goes into APIs, intermediate companies. So alkylamines, for example, remains a large holding for us, and we're continuing to look at more companies there. We spent a lot of time talking to pharma ecosystem players in America and India. We are not seeing price pressure in the pharmaceutical space. There is pressure in the agrochemical space. That's a very distinct industry.
Saurabh, tell me, after the peak summer rally of this year, in the recent aberration that we've seen in the markets, have you made any new additions, be it the Little Champs portfolio or any large caps?
So we're actually making several additions to Little Champs. I think the jitteriness that you guys were highlighting a few minutes ago, we're kind of quite enjoying that. So the one I can talk about is RHI Magnesita. So we've added RHI Magnesita to Little Champs portfolio. This is actually very similar to what we did with GMM Pfaudler 4 years ago. So RHI Magnesita makes the refractories, which go into, this is the kind of ceramic lining, the brick lining, which goes into steel plant furnaces or cement plant furnaces. This is the world leader. They have around 35% share globally. This is the India leader. They have 40% share in India. Good gross margins, 40% gross margins, 15% operating margins, around 30% ROC. Near debt-free company. It's an Austrian parent, listed in Austria, and the Indian subsidiary is what we have invested in over the last couple of weeks.
Get in your thoughts, Saurabh, on the kind of trend that we've seen with these record bulk share sales and of the promoters as well that have been recently offloading shares of their company, the trend that we've been seeing over the past few months. Just wanted to get in your take on the same.
I think the way I'm seeing it is this is sort of one cycle of investing broadly coming to an end. So if you take, again, just to reference our investment in GMM, and this I'll stress here, the stocks I'm mentioning, I'm invested, my parents are invested, and our 10,000 clients are invested. So just to sort of reference GMM, DBAG, the private equity firm, entered GMM 10 years ago. Typical private equity investment cycle is 7 to 10 years. And DBAG therefore exited to Chris Cap. So DBAG sold their position to Chris Cap, I think last week, right? So I don't think that's good or bad for GMM. It's good at one level that the overhang is gone. But this is a perfectly rational cycle. A generation of investors entered 5 to 10 years ago. They're gradually getting out. I think before, when I was waiting for you guys to talk, you mentioned about the private equity firm exiting Amber. I think this is a perfectly rational cycle. I entered 5 years ago. I've made my money and I'm looking to exit. In fact, we too are doing that with some of our small and mid-cap investments as we refresh the small and mid-cap portfolio.
Saurabh, what could be the trigger now for the market? Earnings are good, inflation is benign, macro, you keep on getting ups and downs here, but in general, macro is steady, flows have been decent, the outlook by corporate India is not that bad. So some would say that for markets to now move higher, what is next?
I think if I had to sort of pick one positive trigger and one negative trigger, the positive trigger I would say is the China play, right? Because the scale of China's unwind is such that I find it hard to believe that it will not trigger broader corrections in commodity prices and then onto inflationary numbers, both for America and for India. So I think that's the positive trigger to look out for, Chinese unwind leading to deflationary impulses the world over, which then leads to abatement of concerns around interest rates. The negative one, I have to confess, in India's case, I think we've got so many elections ahead of us. We've got 5 assembly elections through the winter and then obviously the big one in the summer. We are getting the foreign investor community asking us questions around the election piece. And it is what it is. We'll have to deal with that. I keep emphasizing to foreign investors that ours is a robust democracy. And we go through elections every 12 months. We go to some sort of major elections or not. But all of that being said, I think there will be a degree of concern as we go through the election cycle in India.
Saurabh, does it intrigue you, the underperformance in HDFC Bank? I mean, I know it's part of everyone's core portfolio, the best compounder. You're not going to touch it. But why this underperformance now that the merger is done and dusted?
I think, firstly, I think it's worth emphasizing that HDFC Bank is only underperforming compared to its own stellar history. So if I look at the 2-year compounding in HDFC Bank, and it is a large holding for us, I think 2-year returns have been around 15%. Now, compared to HDFC Bank's history of 20-21% compounding over 35 years, it does feel that 15 is a weak number, but it's at one level not that bad a situation. Secondly, the merger is the largest we've seen in the financial services sector, and all said and done, they do have to add 1,500 branches a year to keep up with the liability ask, right? Sashi and the team have been very clear about how hard they're working to raise liabilities. They want to replace HDFC Limited's wholesale market funding with CASA funding. People like us believe them that they can do it. We've seen them deliver on the 1,500 branches rollout number over the previous fiscal, and we believe they can do it. But there are other people out there who perhaps don't know HDFC Bank so well and haven't understood the sheer muscle of this franchise as well. They are probably waiting and watching, and we don't mind that. It just gives us that much more opportunity to keep building a big position here. But I think that's the big unknown for the market. Can you pull off this sort of liability ramp up? I don't think any other lender in India, any other bank in India can. But we've seen HDFC Bank do it. Just to sort of remind people who missed the stat, in the quarter ending March 23, a full 25% of India's incremental liabilities went to HDFC Bank. That's the scale at which these guys are ramping up. This is one of India's, I think, when you add up the two numbers, HDFC Bank and HDFC Limited, you'll get a company who will account for 11-12% of the entire country's profits. So it's a colossal company now, and perhaps the scale of what's transpiring is not easy for people to understand.
I'd like to draw your attention to the talk of the town, and that's Jio Financial Services. And why am I bringing it up? I know you don't own the stock, but you own a stock which is in the mutual fund distribution, Prudent. If a large business house is looking at creating a financial behemoth which would be based on technology, it will have an edge on distribution, it will have the advantage of skill and scale. What do you think will be the disruptive impact of that on banks which are in distribution, for companies like Prudent which are in the distribution business, for companies like India Infoline which get a large part of their business from wealth management? Are we looking at a very disruptive kind of a move coming because of the entry of Jio Financial Services?
I think I'm glad you raised the question, Nikunj, in the context of the mutual fund and the mutual fund distribution piece, because I do believe that's exactly where Jio's disruptive impact will be great. I don't think Jio's disruption will be as profound in the lending side, but a combination of Jio and BlackRock, and you put that on a app, and given Jio's well-known muscle in telecom, you can potentially sell a 5-bit nifty tracker fund to the whole country. So I think there is hope for disruption there. The reason we are not losing an enormous amount of sleep on it is as follows. There are broadly three segments in which the whole wealth management industry operates. The first is affluent people say we've got $1 crore or more to invest, and the wealth managers, the wealth management arms of the banks or the specialist wealth management houses, 361, Motilal, etc. They cater to that, right? That's the 1 crore plus segment. Then there is a kind of middle segment where people are saving between 5 lakhs to say 50 lakhs, right? 5 lakhs to 1 crore. That middle class mass affluent segment is where a Prudent is very powerful. I think they've got 100,000 mutual fund distributors, advisors who are catering to that 5 lakhs to 1 crore segment. And then there is I would say 1 billion people below 5 lakhs. That's where I think Jio will be super powerful. That 1 billion people below 5 lakhs, nobody else has found a business model to get those guys to put in 5,000, 10,000 a month into the stock market. And I'm hoping that's the segment which is basically financialized by this incredibly powerful model of Jio plus BlackRock plus telecom. If that happens, you've got three markets, the mass market, billion Indians coming into the stock market for the first time, then the mass aff that Prudent is playing, and then there is the wealth managers, the 1 crore plus ticket size investors. And the income tax data is very encouraging for these people. The income tax data shows a 50% growth in the number of Indians filing 1 crore plus returns, 50% compared to 4 years ago. So three different strata, and therefore I'm not so sure the players should lose too much sleep. Prudence of the world should lose too much sleep. But for mutual fund distribution, this could be a complete revolution, what's lying ahead of us.
Saurabh, great to have you on the show. Thank you so much for taking the time out and speaking with us as always. Okay, that's the view coming in from Saurabh Mukherjee from Marcellus. Quite a few interesting stock ideas in there. But let's just revisit what the market is up to, because we continue to lie low. That 0.5% dip is being maintained from opening. We did see a smidge of a recovery, but that also got sold into. What's under pressure, you would ask? IndusInd Bank, Wipro, Dr. Reddy's, which is down about 1.5% right now. ICICI Bank, TCS, L&T, ITC. So it's the heavyweights which are pressurizing the markets right now. Same is the case with an Axis Bank as well as HDFC Bank. They also continue to drag lower. Within the broader end of the market, it's an interesting set of names out there. Ambuja ACC are down. There's Syngene, which is down 1.5%. And guess which is the top drag within the liquid universe? It's actually Trent. That's down over 2.5% as we speak right now. Let's just bring up the intraday graph of Trent and we'll get a better sense of what really is happening there. Trent is now down almost 3%, but it's still holding on to that 2,000 mark as we speak. But let's just focus on another underperforming sector, and that's been metals. That's been clearly losing sheen of late. You know, call it the impact of the Chinese economy on global metals, the best of the commodity upcycle. Is that behind us? A lot of questions in the investor's mind on the street as well on what's really ailing the sector right now. Rakesh Arora, founder at GoIndiaStocks.com, joins in on the show right now. We also have RK Goyal, the MD at Kalyani Steel, joining in on the show. Gentlemen, both of you, thank you so much for taking the time out and joining in. Rakesh, if I could start the discussion with you. I mean, the Chinese economy languishing, the impact on the global commodity market, do you think that's one of the key triggers which is weighing heavy on the metals market?
Yeah, definitely. China being 50% of, all global commodity trade, whatever happens in China has a big influence. So currently, there's a mixed feeling. At the one end, you have economy which is not doing that great. And at the other hand, there is expectation of stimulus. So we are into kind of a snooze zone at the moment. People are waiting and watching as to which way it will go. It will take quite a lot from the Chinese government to really propel demand for commodities. So they would need to come out with some fiscal stimulus, which they have hesitated till now. And monetary policy stimulus, which they've been giving, have been largely ineffective. So it's a wait and watch situation from a Chinese point of view.
If you take China out of the equation and throw in the upside which could come from India and the surprise which could come from Europe and let's say Europe and US, could that net impact be positive or it will be still neutral?
So see, US and UK both are kind of, US is expected to get into recession and UK is kind of already there. So they are unlikely to move the needle as much. And India is only like 5-7% of global trade. So at the best, we can have some domestic demand and people can sell material. But prices are largely, driven by global, trade, etc. So Indian companies might not have too much of issue selling the volume, but pricing may not be that great.
Somebody who's looking at buying into metal stocks, should one avoid them? Because metal stocks have corrected. Every time the name China comes back, markets get excited. 5-7% move normally comes in. Do you think one should avoid falling into this trap of buying metals because China will come back?
So there's two trends which are, dominant here. One is that Indian, steel companies, etc., have strong balance sheet this time around. Going into down cycle less compared to previous down cycles where they were totally loaded into debt and had expanded capacities. This time it is not the case. So stocks are trading at a much reasonable valuation, or I would say a better valuation than they would otherwise in such an economic situation. Number two is that the smaller companies are getting re-rated because investors are waking up to the value proposition those companies had. So they all, which were trading at 3-4 times EBITDA, have been now pushed to 6-7 times. So these are the two, broader trades which are happening.
If I could get you in on the discussion, you think steel prices could rise from the current levels, or do you think macro challenges are going to continue to restrict upside? Key amongst that being, what's happening with China. Mr. Goyal?
Hello.
Yes.
Can you repeat the question?
No, I just wanted to understand what your sense is on steel prices and whether the upside is going to be restricted with regards to what's happening within China.
Yeah, good morning. As far as whatever happening in China and the suits which are expected in view of the situation of Evergrande and other large infrastructure companies, there is a possibility China start dumping much larger volumes in India. So there will be a much larger pressure on the prices. So that is what is expected. But at the same time, India's story is very good and Indian local demand is good and it will increase. So by and large, situation for Indian companies may be stable. At the same time, there are better opportunities from Europe and USA, even though they may get into a sort of recessionary cycle. But then the local manufacturing there is very expensive. So India is quite competitive and India can export much larger volumes, not only in the form of steel, but then the products of steel where there are no quota system or any such things.
Well, if you were to really paint a macro picture, would you say that the best of the commodity upcycle which began in 2020 clearly is behind us?
It appears that way because the prices of all other commodity products and particularly steel ferroalloys have also started coming down.
Rakesh, let's switch from steel to specialized steel. Specialized steel is a space where, the China factor is not there. That is one space where you have the space program which is picking up. You've got the defense program which is picking up. Kalyani Steel, for example, is a steel company. They would be supplying steel to auto ancillary. Do you think this entire China correlation will only apply to HRCs and cold roll? It may not apply for specialized steel and other pockets?
Steel pricing is an add-on to the base steel price. So there will be an impact. There could be a delayed impact because, sometimes these guys have, longer term contracts, ranging up to, I think, 1 year contract. So the pricing could be having a differential or a deferred impact. But, nobody can escape if the base, steel prices are going down.
Our advice to our viewers, Rakesh, is that one should not buy into metal stocks. Doesn't matter how cheap they are, doesn't matter how much they've fallen. The best of the cycle is behind us, and if you go against the cycle, then it's a problem for an investor.
So I would say that, you can be a little bit stock specific. There would be stock specific stories which will be available in the market. But as a theme, I don't envisage, big bull run into metal stocks. Even if you look at the last, 6-month returns, it's way below what market has given. So since market is going up, they will also, they'll be popping up rotation into, metal stocks which look value. But apart from that, I don't see a big bull run.
If I were to talk about, the fact that you're a provider of forging quality steel for a variety of automotive applications as well, help us understand, given that, demand is really booming within that sector of the economy, how can that sort of bridge the gap with the impact of, what's ongoing in China and the demand slump thereof?
Hello?
Yes, Mr. Goyal, go ahead.
Okay. Now, as far as the specialty steels and super specialty steels are concerned, it is not only the product, it is the service part also, where China finds it very difficult to compete with us. They can definitely export to India some large quantities where it is few hundred tons and all, but specialty steels are serviced in the form of even 5 kg to 500 tons. And that's where we do not hardly have any competition from China. So as far as our sectors are concerned, we have long-term contracts and long-term approvals. This is a business which is in relation to the approval part. Like any material which you want to supply to space, aerospace, energy sector, automobile sector, you need to have approvals which may take anything between 3 months to 5 years. So we do not see much of increased competition from China. And since the passenger car is doing very well, medium and heavy commercial vehicle production and demand is growing up, we feel that the situation is likely to be much better, and we will not face much of this cost pressure because already the prices have gone down. We have already corrected the price to our OEMs. And on the contrary, we see much larger export markets, particularly to Europe and USA. So I strongly believe that the specialty and super specialty products, particularly for forging industry and component industry, will do well.
Mr. Goyal, Rakesh, both of you, thank you so much for taking the time out and helping us understand what really is happening within the metals market and how the dynamics for steel are playing out globally as well. Okay, from metals, let's now talk about what's happening within the chemical sector, especially in the light of some of these global players coming out and sounding off warning signals of slower demand coming by. Have the chemical sector's margins then normalized? Can we expect a recovery in the second half? And should you be, as an investor, looking at investing in some of these names? Let me take it across to Lisa, my colleague, and firstly highlight what's really going on with the sector and the stocks thereof.
Right. So let me take you how these chemical companies, they performed in Q1. So Q1 saw a continued dismal performance for the chemical companies, and it was attributed to a double whammy kind of situation. Well, on one hand, the China dumping that led to impact on the pricing pressure, which hit the realization, and on the other hand, the subdued demand conditions that hit the volumes. So yes, it was a double whammy kind of situation, and also slew warnings coming in from global companies, where one company, Lancex, also highlighted and they warned of a Lehman 2 kind of crisis in the chemical industry. So that does create some kind of shudders. But then coming back to the earnings, sharp cut was seen in the earnings, but the valuation has not corrected that much. And also the capex plans has remained unhindered, and there's not much deferment in the capex plan. So that goes to show that the management, they are expecting that these challenges are temporary, and that management also highlighted that the recovery is anticipated in the second half of FY24. So yes, there are medium-term challenges, but the long-term story for the chemical industry, that remains intact on the back of structural drivers. And this is on the back of two reasons. One is that India is growing at a better pace than most of the major companies, major regions, as well as the Indian chemical companies, they are still a preferred suppliers over China. So yes, we also, these are the challenges and these are the long-term drivers, but then we also need to watch out for how the demand will pan out going forward, whether this demand slowdown will continue for an extended period of time, and whether this China dumping will continue for longer than expected. So that was on the chemical check.
Let's take that conversation forward. Ajay Joshi and Vishal Thakkar, they both join us. Let's understand first from Ajay, that has the cycle really turned for chemicals? Ajay, has the cycle turned for chemicals per se, or this entire dumping from China will continue to drag it down? If yes, where it has improved, where it has not improved?
Okay. No, actually the cycle has not changed. The dumping will continue from China till Q2 also. Towards Q3 end, we will see some improvement, because China dumping will face the growing demand from the Latin American and Southeast Asian market. So then Indian companies could have a chance to compete with Chinese companies. But at least for Q2 and Q3, the situation will be very similar to Q1. Most hit would be taken by agrochemical and commodity chemical companies, but companies involved in contract manufacturing and specialty chemicals, which have diversified exports as well as diversified end segment sales outlets, not only depending on one segment like pharma or agro, but multiple end industries like paint, coating, auto, etc. Those companies will be able to sail through by Q3, but otherwise Q2 and Q3 will remain same for all other companies like Q1.
What will change, let's say, now till year end, Ajay, that you feel that things will start improving? Because if at all China actually is consuming less, if at all the global demand is not going to, change in a meaningful manner, what will change between now and December that the downturn will become an upturn?
Okay. So by December end, India is working on a lot of global policies as well as FTA with its Southeast Asian ASEAN neighbors. So they are highly dependent on China as of now because of their free trade agreement from China, because of the duty benefit. Now the Indian government is coming up with with some revision in policies, which will make India much more competitive than China towards the ASEAN nations. But ASEAN nations, whether it is Indonesia, Vietnam, they are also a consuming nation similar to India. In today's time, where China demand is very, very low, the demand from India, Southeast Asian nations are very, very strong. So that will give some pull to Indian exporters. The second factor will be the agrochemical season will be back in Latin America by October, November. So all the global principals, whether it is BASF, Syngenta, Corteva, who outsource the contract manufacturing part to Indian companies, they will also open up the order pipeline for future orders. So that will give some boost to Indian exporters in the chemicals segment. So these two will be the main drivers for growth.
If I could get you in on the discussion, considering you are an industry player, wanted to understand from your sense, because, you know, on one hand, you've had large global companies almost warning of a Lehman-like crisis within the chemical sector, but domestically, things don't look all that bad. Tell me, is it really burning down for the chemical industry?
Okay, good morning. First, you have to divide two European players into two parts. One, who are the patented players and the innovators, and two are the CDMO players who are supplying to those kind of players. So let me talk about what we are talking about, Syngentas and Sumitomo's and your others. They would be the one part of it. But second part, if you look at it, the Lanxess is basically suppliers to these kind of players, right? And if you look at it for India, on the commodity side, yes, China play will come into play to a large extent. But when you come to the CDMO side of it, we are suppliers to not to Lanxess, but we are suppliers to Syngentas and Sumitomo's, right? When Syngenta and Sumitomo will move their demand more from Europe and China to India. So if you really look at it from that perspective, Lanxess making that statement makes a lot of sense to us. But from an Indian player point of view, net, if you see, let's say Syngenta is dropping their volume by 10 percentage point, the large impact will go to Europe and to China and less to India. And hence we feel that India will remain robust, especially on the spec chem side and especially on the CDMO side who have long-term contracts. I think there we would be able to see a very, 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 very stable demand. Yes, it may be pushed by a couple of quarters as that may be the case, but from a YOY perspective or a going forward perspective, I think we should be good. That's my view here.
How will you apply that to your portfolio category? What you've shared with us is big picture. Walk us through individual categories where you think for Anupam Rasayan things will look up.
So for Anupam Rasayan, see, we are largely agro and into life sciences mainly. And if you look at it there and personal care there, right, there what we are seeing is that the demand, because I tend to tell again and again that we have a long-term contracts and our demand is typically underwritten. And typically that is underwritten by people like Syngentas and Sumitomo's and Bayers of the world. Now, yes, within the year, you may have a shifting of the demand from quarter 1, quarter 2 to quarter 3, quarter 4. And typically you will see that the first 2 quarters, there will be a little bit of a less buoyancy. In the third and the fourth quarter will be higher buoyancy because of agri cycle that our co-panelists also mentioned. So from our perspective, we see that the first 2 quarters may be flattish and the second 2 quarters will catch up for the demand. So that's how we would see the demand for the year. Growth, not only demand, I'm talking about growth.
And Ajay, I wanted to get in your take just when it comes to the sector outlook. In terms of the recovery, the chemical space is, of course, very vast, commodity, specialty, agrochem, etc. Which segment, according to you, is likely to see a smart recovery, and what is the sort of timeline that you're looking at?
Specialty chemicals will see very, very fast recovery. From Q2 onwards, the order pipeline is opening up, and China is getting weak in specialty pricing because of their raw material pricing. For commodity, the situation will improve towards Q3 onwards only. And for agrochemicals, for the formulation companies, not for the contract manufacturing companies, but for formulation agrochemical companies, by Q4 of this fiscal year only, there will be some positive turnaround. Overall, net, specialty chemicals would be the fastest gainer, and the companies involved in that segment we will see the moon landing type approach from them, Q2 onwards.
Ajay, I go back to that very basic point that China right now has excess capacity. The demand is not there, whether it is local demand and whether it is global demand for Chinese products. If you're a Chinese manufacturer, you know that I have to sell. And the only way I can sell is that I have to make it more attractive, which is I'll have to break the prices. So once local demand is not there and the acceptability for Chinese made in China products is not there, do you think this will actually have a far greater disruptive impact, and this could be a multi-year phenomenon because large capacities now will have to sell at rates which are not economically viable for them?
Yeah. Very fair point. And this is actually happening for a lot of export destinations, popular export destinations for India, like Latin America, Southeast Asia. But we need to see China on a global level also. Its trade tensions with a lot of countries. If we take US-China trade, US has imposed a lot of import duties in the range of 20 to 30% on import of chemicals from China. So US demand is entirely moving towards the new supply source, and India is coming out to be the most reliable partner for a country like USA. Similarly, like I said, a lot of Southeast Asian companies, they got troubled from Chinese suppliers a lot immediately after COVID. So China, although is the cheaper supplier, the undercutting supplier, but it's not the most reliable supplier still. So for that part, the secondary supplier comes out to be India. So that is giving India some limelight in the Asian market, which used to be the popular Chinese destinations for export. Another market where India is trying to expand its base beyond agrochemicals is Latin American market. Latin American market, I always say it's an underdog when it comes to personal care, home care chemicals, construction chemical segment. Indian companies mainly focus on in agrochemicals there only. But Latin America also, India and Brazil are going to have a new FTA in place by year end. So that will further boost the export of specialty chemicals and commodity chemicals from India to Latin America also. So overall, the China price erosion phenomena will slowly die down towards the end of this fiscal year by Q4.
Okay, gentlemen, both of you, Ajay as well as Vishal, thanks so much for taking the time out and highlighting what's really going on with the chemical sector right now. Watch out for what the market is up to, because there's been a large sizable block deal on Jio Financial Services, large volumes, I beg your pardon. So look out for that, and look at the kind of sharp correction that you're seeing on Shoppers Stop as the MD and CEO, Mr. Nair, actually stepped down. The new MD has been announced, but still it's an 11% downtick and no resurrection for Shoppers Stop whatsoever in trade. Couple of dots of green also in the market, and let's not ignore that too. So Bajaj Finance, Bajaj Finserv, Adani Ports, they're all holding out in trade. IDI, even though the subscriber additions for the month gone by have been extremely weak, that stock is still holding up 3%. Sun TV has been a very actively traded one of late, has had an excellent week. Another 3% of a bump up coming in on Sun TV. Birla Soft, Indus Towers, Granules, these are all names which are holding up very, very smartly in trade. But yeah, for the index, we're down 0.5%. But, down, not out, still one would keep it at that. Let's now talk about what's happening within the railway sector. And one stock that comes to your mind definitely is Sitagarh Railways. That stock has been on a 52-week high. There's been a lot of frenzy in the market as well about it. So let's really get and understand the dynamics of what's really happening with the sector as well as the company. We have with us Umesh Chaudhary, the VC and MD at Sitagarh Rail Systems, joining in on the show right now. Umesh, great to have you today on ET Now. Morning, firstly. I wanted to highlight a little bit about what we've seen in the first quarter from you at Sitagarh, because your margins did increase. We've seen higher share of private sector wagons as well. But tell me, what could be the share going forward, and where do you see your margins trending, say, for the full year?
So, good morning. Thank you for having me with you. As far as our share of the private sector wagon business is concerned, we pretty much are leaders in that as well in terms of our order book. We have the largest order book in the private sector wagon space as well. So we kind of balance the mix of the supplies between the railways and the private sector, because railways are more long-term customer, much larger customer. Private sector, while they give us better margins, they are more, smaller contracts and not a very stable kind of contract inflow is there. So it depends upon the industry cycle. So we continue to balance both the private sector and the railway wagon supplies on a quarter-by-quarter basis. As far as the margins of this business is concerned, we've always maintained that this is a 10% EBITDA business on a sustainable level. So while some quarters, can be better and some quarters can be not so good, but 10-11% is what we are expecting as a sustainable margin over, let's say, 8 to 12 quarters. I'm not talking about a quarter-to-quarter basis, but 8 to 12 quarters.
So, what we understand is that you're already clocking about 650 to 700 wagons a month, and you have a target to produce even 1,000 by the month end of FY24. Are you on track for this target?
Absolutely. We are very much on track for this target, and we are doing now about, as you said, 650 to 700, and this financial year we are targeting to touch the 1,000, magical 1,000.
You are looking at increasing your capacity, which you've already done. Can I assume that in the near term, your return ratio, especially a number which I look at, markets always look at, ROC, ROS, it will also remain depressed? Because you are in the middle of the CapEx.
As far as our ROC is concerned, if you look at the ROC of the company over the last 5 years, we have really quite substantially. And the incremental capex that we are incurring in order to increase capacity is not, an equal proportion. It is lesser than what the growth of the business would be. So going forward, we would only expect an improvement on ROC, not a depression on ROC.
And given that you ended FY24 Q1 with an order book of about 27,900 odd crores, you had the Surat metro rail order, you had orders from the private sector. What are some of the other orders in the pipeline, and what's your targeted order book?
So the tailwind in the industry, thanks to the Atmanirbhar Bharat policy of the Prime Minister, the Make in India policy, and the overall infrastructure that is getting created in this country, I think this is the time for India, and we are just riding that wave. So in terms of the other orders, I think we would only like to speak about it when they kind of get concluded. So we will definitely come back and announce them. But nothing at this point of time that we can announce. But all I can say is that thanks to the infrastructure thrust that the government and the Prime Minister has given, and particularly I'm a firm believer that the Atmanirbhar Bharat policy and the Make in India policy are the biggest game changers for Indian manufacturing industry post-independence. So, these are the policies that have given companies like ourselves, like Titagar, an opportunity to grow up in scale and size and actually look at becoming global, which is going to be our target going forward.
I want to look at your stock price, sir. I just want to look at it. Why? Because it's just mesmerizing the way stock's gone. I've seen multi-baggers in my past, but Titagar is up in last 52 week, 140 has become 800.
The last 6 months, it's been up like 200% almost.
Yeah. And let's look at the stock here. We look at the 5-year chart here. For the first 4 years, the stock in a sense was flat, but in last 1 year, it's really the whole idea which markets are excited about: defense, railways, Vande Bharat, new businesses, new wagons, modernization of railways, strong government capex towards railways. It took 2 years for markets to realize that railway is going to be the high growth multiplier for the economy. And look at the stock now. Between 2019 to 2020, it actually did nothing big. But the incremental gains actually have just come after that, and that's been magical. Do you feel happy when you see a stock go up like this? Or it's like, okay, I don't care, doesn't matter to me. We are not looking at raising capital.
I would be honest. It does give us a lot of sense of gratitude that the market and the investors have kind of kept their faith in us. But also it gives us a huge sense of responsibility. But what I would also like to add is that I've always maintained that our sector is like the last mile sector. So the railways in the last 9 years, particularly under the government, has done a lot to build up on infrastructure, and that is in fact equivalent to creating capacity. If you look at railway as an industry, by building infrastructure, by investing on track, on signaling, on locomotives, they've created capacity. And in order to utilize capacity, they need rolling stock. So we are at the last end of the spectrum, and that's what is coming. In terms of the company itself, March 22, we had announced an order book of about 1,500 crores, and March 23, as you just mentioned, June 23, we announced an order book of about 29,000 crores. So from 1,500 to 29,000 is definitely a big change in the overall dimension of the company, and definitely in terms of how the market has kind of reacted to that, and the movement in the share pricing, and also the government, because they have kind of depended upon us. They've trusted us in giving us the opportunity to be a part of reconstructing the Indian infrastructure. So that gives us great humility, but great responsibility and satisfaction.
As the trials for the traction motor supply gets the clearance, this is going to be a new revenue stream for the company. Approximately what kind of revenue are you looking to garner from this? And can you tell us what we can expect?
Sure. So the propulsion and the traction motor business is going to be actually a very key part of our strategy because of two reasons. One is that it is going to be a backward integration to our passenger rail systems business. So as Titagarh Rail Systems is now structured, we have the freight rail systems and the passenger rail systems, and keeping the rail system, the rolling stock, at the central point, as the central point of our strategy. We are actually
Right. Mr. Chaudhary, I'm afraid I'm going to have to let you go there. Appreciate you taking the time, genuinely. Thanks so much for joining in. But let's cut across to N. Chandra speaking at the B20 conference.
For India to lead the creation of an alternative supply chain. So India has many things that goes in its favor. Also, the transformative government initiatives such as the public digital infrastructure, the PM Gati Shakti, the PLI incentive schemes, the Startup India, reduction in corporate taxes, and many of these initiatives are helping India sustain the fantastic economic momentum that we have among the G20 countries. But at the same time, India and all of us here are super committed to equitable growth, particularly in the global south, committed to sustainability and climate action, committed to innovation, and therefore India's growth journey will shape the world's future. So all of these thoughts that I talked about went into the actions that we wanted to take during the B20 India's leadership. When we took over the presidency from Indonesia in November last year, we aimed to build on the great work done by them, and also to create new pathways for finding solutions to some of the world's pressing problems. At the start of our presidency, after a lot of collaborative discussions, we came up with the slogan, RAISE, which is being responsible, accelerated, innovative, sustainable, and equitable growth for all businesses among G20 and outside G20 nations. Through a consultative process, we engaged stakeholders across the world and came up with 9 themes, and we formed them as 7 task forces and 2 action councils. The task forces worked on the themes of global economic recovery, inclusive global value chains for resilient trade and investment, financial inclusion for economic empowerment, digital transformation, collaborative work in technology, innovation and research, and future of work that is required in terms of skilling and mobility. And finally, energy, climate change, and resource efficiency. The two action councils worked on embedding ESG in every business, and the second one on integrating Africa's economic development with the global economy. Since we started this work in January in right earnest, we have had about 110 policy advocacy sessions and initiatives across 29 locations in India and abroad. Today, I am delighted to say that we have a very strong set of recommendations. In total, 54 recommendations across these 9 themes, and each of those recommendations have got policy actions, multiple policy actions numbering 172. These 54 recommendations and 172 policy actions have come out of the consensus that has been achieved across over 1,400 participants who have actively engaged to work with the task forces, action councils, and through the International Advisory Caucus. We have received enormous support, feedback, pushbacks, and engagement to get a set of recommendations which are sharp and which can make an impact. While each of the chairs of the task forces and action councils have led from the front, and they will have the opportunity to share directly the work that has been done and the recommendations out of their task forces, I thought I will call out a few important recommendations, more the themes of the recommendations, and then the follow-ups that we want to do going forward. The first that came across as a theme across all the 9 aspects is the concept of inclusion. It resonated across the board. So our recommendations request the G20 to prioritize inclusion relating to least developed economies, global value chains, access to finance, and access to digital literacy. We have incorporated the priority of gender development in all our task forces and action councils. We want to make sure that we measure the progress of women in all dimensions, whether it is in entrepreneurship, whether it is in skill development, whether it is in investment, trade, across every dimension. We want to see notable progress on gender diversity. The second, we have advocated strongly for financing for global recovery and for climate transition. The SDG financing is assuming a central role and needs a coordinated global response. We also have specific callouts for promoting the growth of MSMEs across all nations by providing them the necessary financial support and all other policy support that is required so that the MSME growth will become fundamental to drive the global economy. Third is about skill development and global capacity building on workforce mobility in order to address the needs of a digital future and new technologies that will be required for energy transition and Industry 4.0 overall. Fourth, the G20 will accord, we have requested G20 to accord higher priority to the needs of Global South in all our deliberations, particularly in financial support. The B20 agenda explored the global value chain resilience and how to bring in least developed economies, MSMEs, women, and youth in the global trading arena. And the sixth we have also advocated for harmonization of frameworks for ESG, standards in the measurements of climate change, and skills that are required to be uniformly available across the globe by facilitating knowledge sharing, by facilitating movement of mobility, cross-border exchanges.
All right, that's a view coming in from N. Chandra talking about the overall tech landscape. Tell you what, we'll take a very short break right here on the show. Be right back for more.